Greetings from our team at Robare and Jones Wealth Management. This is Jack Jones, the managing partner, for the second month of market update for the month of March. With everything that's going on with Silicon Valley Bank, the Fed, inflation, interest rates, we thought we'd give you a quick update toward the end of March. Before I begin, I want to thank our clients for the trust and confidence that you place in us. The very best part of our day is time spent directly serving you. We hope to see many of you at our upcoming forum, where we'll continue to unpack these issues on Wednesday, April 19th. If you haven't RSVP'd, please do so. So this picture tells a lot about what's going on. QE was where the Fed was up until about 12 months ago. 12 months ago, and we'll talk about this, the Fed started what is now, as of last week, 9 consecutive interest rate increases. And you'll see one of the casualties of that, we'll talk about in a second, is Silicon Valley Bank. So the last 2 weeks have seen a lot going on. Jerome Powell, March 7th, talked very hawkishly about inflation and raising interest rates. Only a few days later, we had the failure of Silicon Valley Bank. Unemployment report was mixed, still low rate, but wage pressure is lowering, which is good news for inflation. Then you had another bank failure, Signature Bank. CPI was about what was expected. We'll talk about that a second. And if what's going on here isn't significant enough, you had Credit Suisse having some issues in Europe. So a lot going on. What's interesting is, in spite of all of it, for the week ending March 24th, markets were actually up in the 2 preceding weeks, the week that ended March 24th. So let's talk about Silicon Valley Bank for a second, which was taken over by regulators on March 10th. At that time, it was the 16th largest bank in the US. So a brief history of kind of what happened to Silicon Valley Bank. Asset base jumped from 61 billion to 189 billion at the end of 2021. Interest rates were very low, so in an attempt to get higher yields, they increased their maturity, and they increased their interest rate risk. Now, if you held those assets to maturity, that's fine, but if there needed to be massive withdrawals, which is what wound up happening, they had to liquidate assets at a loss in order to fulfill those, to fill the withdrawals. Putting it simply, SVB didn't have enough on cash on hand, so it began selling a lot of these bonds that were down because interest rates had gone up so dramatically, which had the result of making investors and customers nervous. And again, they were taken over on March 10th. Just to put a little bit of that in perspective, now the year is young. Whether this winds up being a contagion or a further risk issue is something that we're watching carefully, but so far 2 banks have failed, the 2 listed here in 2023. If you go back to all the bank failures in the 08, 09, 10 perspective, obviously a lot more. Again, this doesn't mean this won't get worse. It very well could, but right now, any comparison to the bank failures in 08, 09, 2010 are premature. So what has the Fed been doing? So this is kind of what happened, starting March of 2022. The Fed has started, again, ending with last week, where the Fed raised rates 25 basis points, 9 consecutive interest rate increases to combat this. We saw a June high of 9% on CPI, most recent reading of 6%. But they've done that to combat inflation. So was 9% peak is a key issue as it relates to historically looking at financial markets. Going back to 1934, if you look at the 12-month following an inflation rate peak, on average stocks are up this amount, and on average bonds are slightly down. So on the stock side of portfolios, on average, and this is where we were, by the way, the yellow is where we've been since this June 22 peak. But on average, if you look at stocks and bonds after an inflation peak, you're up 18% and almost 8% over the next 12 months, going back to 1934. So the big question is the Fed done tightening? We don't know that for sure. I think we can pretty safely say that we're closer to the end than the beginning. One of the interesting things in language in terms of the Fed meeting recently is that they've shifted the phrasing a bit from ongoing increases in the target range to some additional policy firming. So that may seem like a distinction without a difference, but it's a slightly kind of less hawkish description of forward Fed moves from here. This is just a graphical look at this rate of increase of interest rates compared to prior cycles. You can see the red very steep and very quick. And where the Fed is as it relates to last interest rate increase is relevant. Again, we're not saying we're there in terms of rate increases being over, but once we get there, this going back to 1994, the average 12-month returns on stocks and bonds is pretty positive once you get to the final interest rate increase. So once again, we hope you'll join us at our quarterly investment forum. We did wanted to give you a few thoughts. We'll be expanding on those on April 19th. We will also be rebalancing in the coming weeks to address some of the market concerns. We'll be sending out trade notes in front of that so that you're aware. Again, none of this is a substitute for contacting us. We're here to serve you. Please leave no question unanswered. Contact us if we can help in any way. So with that in mind, we'll close. We hope this note finds you and your families well. Again, if we can help you in any way, let us know. We look forward to seeing many of you at our upcoming quarterly investment forum. Until we see you again, be well and take care.